Although interesting news, the office using jobs are still rising by 2% a year.
Of the 5 product types, 3 of them are really uninvestable from our view today.
Yes, we are seeing incredible disruption in the capital markets today because 85–90% of all the banks have kind of hit pause.
Where we feel the growth is and the development is, and utilizing our skill set to the best possibilities.
Cities, states, counties, and nations are facing significant challenges around housing.
Well, everybody, it's nice to be back. And
Lost the crowd, see?
I'm a mom, and out of respect to my panelists, we decided to come back on stage because many of them have traveled from far. And if you guys could take your seats and give them your attention, I would really appreciate it. You heard the introductions, so Professor, since we need to sort of get back into the groove, before we hear from the panelists about how they're coping with the current environment, maybe you can tee up the discussion with a quick overview of the U.S. real estate fundamentals, because I know that your research covers the 5 major property types: office, industrial, retail, apartment, hotel, in 54 U.S. markets. So I think that would be a great way to sort of set the stage for the audience and for the panelists. Thanks.
Great. Thank you very much. And can we have the slides up now over on the computer desk? Hi, I'm again Glenn Miller from University of Denver. Been in real estate my entire career, 47 years. And back in 1990, I went to work at Prudential Real Estate Investors as a research analyst, helping institutions invest into real estate. And what I developed was a market cycle report that I've been putting out since 1992, going out to thousands of real estate professionals in the country. And I'm going to go through, if we can get the slides up, the 5 major property types. And what I'm going to do is start with the worst and work my way to the best. So as you might all guess, here's slide number 1. Basically what it is, it's an occupancy cycle, where we are in the occupancy cycle. And of course, office today is at the bottom of the barrel. When we look at demand for office, what's happened is people working from home have reduced the demand for space. Although interesting news, the office using jobs, as we call them, which is technology, financial services, et cetera, are still rising by 2% a year. So you think demand would be going up, but now with people working at home, we need less space per each person. And what I did here was, this is my forecast for a year out from now, second quarter of 2004. What you see is I gave you a kind of a contrast there. Cities are all over the country. They're all over on the cycle. The green is the growth phase where you'd want to be, obviously. At the bottom on the far right, and I'm giving you a little contrast here between Dallas and New York. Both of them at the bottom. They have the highest vacancy rates in the country in those markets on the far right-hand side of the slide. The good news is that good premium Class A space is full. Why? Because financial advisors, financial firms are all doing well. They want nice quality space. So that's the unique part of that space that's doing well. On the next slide, we're going to see hotels. And as you all know, so next slide, please. You'll see that the hotel markets are doing pretty well. We literally had, I call it the COVID have and COVID have not. Next slide, please. Basically, resort hotels, conference hotels have come back. And so in major cities, you see Dallas, Fort Worth almost near the top, New York City at the top. New York is not just a business market, it is one of the largest tourist markets in the country, and they also attract a lot of people from around the world. So the one hotel sector that's still having problems are the business-only hotels because people aren't traveling quite as much. Next slide. Industrial, obviously, doing very well. I call it the Amazon effect. You see some markets that are over the top, and that's where we've literally been. The demand is strong in every market in the country, but we've been oversupplying in some markets. You can see that happening with Dallas, whereas New York is at its peak. So, and that demand looks like it will be continuing for a number of years out. So, industrial has been, for the past 5 years, the #1 performing property type as far as rent growth and price increases too. Next slide. Retail is probably the biggest surprise for most of you. Retail occupancies are at their peak in almost every market in the country. Lowest vacancy rates we've ever seen in the cycle, with a few markets over the top just because of some new stuff going. And that's because we've literally restricted the supply. We've held supply back. It hasn't been financeable for many years. And what is being built last year, 80% of all new construction was pre-leased space for a tenant that wanted and needed that space. So again, you see malls being rehabilitated into more experience venues as opposed to just retailing and that type of thing. And then best of all property types, next slide please. Obviously apartments, and you say, wait a minute, best property type, it's there in that third hyper supply phase. You see New York City at the top. New York, the young people want to be downtown. Just talked to somebody here at the conference. Daughter just graduated, wants to live in downtown New York and work there. A 1-bedroom apartment, $5,300 a month. So doubling up with a friend to just try and be able to afford it. Dallas, on the other hand, you see it down there past the long-term average dotted line. Why? Just because of a lot of new building that's going on here. And so it's a situation of oversupply. All of that oversupply that you're looking at there in phase 3 of the cycle literally will go away, in my opinion, in the next year or two, because we are 6.5 million housing units short in this country, according to the National Association of Realtors, and that's both ownership and for rent. We slowed the supply in the Great Recession in 2008 and 9, and we were used to build 2 million new homes a year. We've dropped that to 1 million new homes a year, and so we're in short supply. And pretty much everything except mid-tier houses between 600,000 and $1 million, over $1 million are selling instantly for cash. Under that are people getting in. I'll tell you that I bought my first home in 1976, and my mortgage rate was 7.5%. Okay, so and then 10-year Treasuries in 1981 went to 15%. So it is possible to own a home, and people know that if they finance today and rates go down, they can refinance in a home for free. So obviously apartment's the best property type, but there's always sub-property types, and the two best performing at the moment are student housing. Students want to be in better things than the old cinder block dorm room that I had to go to when I was a freshman, and so student housing is there. And then absolute #1 in the United States, and I believe all over the world, is affordable housing. We are very short affordable housing throughout the world. I've talked to many of you here today doing that kind of stuff. Next slide, please. And I recently joined a charity called Sharing Connection, and we help nonprofits with getting gifts of real estate, take it, fix it up, and get the maximum amount of money for them out of that. Preserving community assets. We recently had a unwed mother's home. The owner was going to sell it, so they were going to get kicked out. We bought it, gave them 5 years to raise the money to own it themselves free and clear, which they did in 2 years. And then helping affordable housing in nonprofits. We have projects in Hawaii, we have projects in Colorado, and I'm looking to all of you to find more projects that we can help with. And our idea is today we're not looking to have you give us money, but loan us money at a lower rate so that we can make the projects work. We need development and construction money, so it's high impact investing but with a moderate return. And so basically we're trying to give and lend with integrity in what we're doing.
Great, thank you so much for that. Richard, maybe we could start with you. I know that you're comfortable with pretty much all property types and that you've owned or currently own all types nationally. Can you share with the audience your feelings about the current market and how you're navigating it at the moment?
Thank you, Kim. We own approximately $1.4 billion of real estate assets. We invest our own money, as set out by you very well. Of the 5 product types, 3 of them are really uninvestable from our view today. Office, because of the work from home and the other items mentioned. Retail, because of the Amazon effect. And hospitality, because of the COVID and all the new product coming in, the asset-light models. As a result, you've really only got 2 areas, which you mentioned. It's industrial and multifamily. And because suppliers of dollars previously could go to 5 areas and now can really only go to 2, the cap rates are absurd. When treasuries were last at this level, which is about 4.7% for the 10-year, we used to get IRRs of 11.5%. Now the models are really underwriting to 8.5%, which really means a 1 to 5% return during the first 5 years. Something's got to give. Either the cap rates have to go up or the interest rates have to come down. And cap rates just really haven't moved far enough up. They're up off the bottom. It used to be a 4 cap. Now things are 5 cap in terms of industrial and multifamily. It's still not yielding enough on equity. So that's, the number one premise is real estate is still too expensive. Not only is it too expensive, but there's not enough financing. We were, a year and a half ago, we were refinancing things at 4%. Now it's 8%. All the return goes to the debt funds, to the mezzanine funds, to the, to debt. It doesn't go to the equity holder. As a result, it's not a great time to go increase your real estate portfolio. That being said, on the commercial side, all the commercial prices are basically down some. Office is down about 30%, warehouses down about 8%, multifamily down about 20%, storage, if you look at the public storage companies, they're down 37%. Hotels have done no better. Sunstone down from $30 in 08 to $9 today. So, my conclusion is that with interest rates up, values need to come down. There's more downside today rather than upside due to the rapid increase in interest rates. We need to take time to let, the market adjust and for prices to continue to slide a little bit. That all being said, what do you do today? I think you do 2 things. 1, you lease and manage what you have. And number 2, you recognize realistically what the return is that you're going to get. That if you purchase quality real estate in growth markets, over time you will do just fine. A 5% cap rate is a 5% return. It goes up a little bit over time, and you'll do just fine as long as it's a quality product. The other reason I have confidence that it'll go up in value is because reproduction cost is going up with inflation. So what you really have to do is hold your powder. You need to invest for the long term, and you know that you're not buying at the top. You may not buy at the bottom, but at least you're not at the top, and you'll do fine over time.
Yeah, one of the things that I hear people talking about a lot now is that there's surprise that prices and values haven't fallen more than they have. This is the quintessential market dislocation, disconnect between bid and ask, which is not unusual. It's just a question of when people start to sort of come to terms with reality. So, Deepika, you're a 3rd-generation hotelier. We've just heard Richard not give a very good picture of the hotel market. Lodging has sort of been beaten and battered, right? It was dramatically impacted by COVID. There was some rebound with all the so-called revenge travel. Now, people maybe are tightening the belts, fearing recessionary pressures. Where is the hospitality space at the moment from your perspective, and where is the Patel family office finding opportunities these days?
Sure, thank you, Kim. So I think from a RevPAR perspective, post-pandemic, it's come back from a RevPAR, but we still seem to be struggling a little bit on occupancy. And those occupancies, along with the challenges currently in the debt markets, the labor issues, supply chain, It's eating into the cash flows, eating into our NOI, and with the constant interest rate flows, we're seeing that buyers, there's a lot of buyers there, but there's not enough availability in debt. And so with the challenges of debt and sellers not willing to sell or come down again with the whole bid-ask denominators that are happening, we're starting to diversify a little bit. So we've pivoted after the pandemic, and I thank perhaps the pandemic for us to make these key decisions. And so we have pivoted a little bit into other geographical locations. We're strong in hospitality, and that's one of our strongest focus. And so we're now focused in some other markets like the Middle East and Saudi Arabia. We recently launched a $5 billion hotel fund in Middle East, North Africa, and Egypt, and we're just kind of following, where we feel the growth is and the development is, and utilizing our skill set to the best possibilities. And so currently, if you think of Saudi Arabia, there's $165 billion in development that's required in order to meet the 2030 MBS vision. And so for us, a $5 million is a very small number, but we see some great potential in some of those growth markets. And so I think from a strategy of diversification, that's kind of where we're looking at this conjuncture.
It's very fascinating, and it's really interesting to me. You're the only woman sitting on this panel, and you and I, having grown up in the real estate business, as the stark minority, right? A commercial real estate conference is the only place you could go and not find a line at the ladies' room. But in any event, that's great. That's really great that you're venturing into those markets and, go female empowerment. That's wonderful that that the initiative is being led by a rock star of a woman. So
Thank you.
So Scott, Deepika did mention the paucity of debt financing. You bring a very interesting perspective to the panel because Ardent plays on both the equity and the debt side. Can you compare the different risk and return expectations for both strategies, debt and equity? Can you also add some color maybe on whether or not, given some of the recent bank failures, is it true that traditional bank lenders have retrenched, creating opportunity for alternative lenders like you? Are you doing any lending now? Are you seeing any distressed opportunities? If yes, where? I know that's a lot of questions, but I have the confidence in you to do a great job.
I'll do it quickly. So, yes, we are seeing incredible disruption in the capital markets today because 85–90% of all the banks have kind of hit pause. They don't know where the lending market is going. So it's created opportunities like Ardent to come in with our financial funds and lend money at SOFR. SOFR today is 530, 535, and we're lending at 650 to 850 over SOFR. Interest rates that would be inconceivable probably 18 months ago and now are very much the norm. And it will be the norm, we believe, for at least another 12 to 15 months until we start seeing some relief in this. On the commercial real estate side, which is the division that I run, we have been very slow to invest on the real estate side for obvious reasons, but we're still active in retail. I know that you mentioned retail as being somewhat negative. We're big fans of retail. 2017, everybody said retail was dead. We didn't believe them. Today, it's as strong as it is. Your graphs speak for themselves, highest percentage occupancies, really significant rent growth. So we're believers in that. We're investing in Charleston, in Atlanta, in London, in Nashville is probably one of the biggest ones that we've done. Our London office has really taken off. We started in the middle of COVID. Everybody said that we were out of our minds to start something in December of 2020, but we realized that the dislocation there, COVID as well as the Brexit opportunity, was really creating even more disruption over there than what we were seeing here, so we could take advantage of some of the lag that was occurring in London. In London, we're also now raising a debt fund, which is going to be £250 million plus minus, to also take advantage of some of the dislocation that's going on there. So while the banks have been on pause, we have been much more active on our debt lending space than we have on the equity space. Normally we would invest $250 million a year. Now we're only investing 40 to 50 million a year and flip-flopped into the debt side.
That's great. It's very interesting because a lot of times you see foreign capital coming into the U.S. real estate markets, and now I've had two of you speak about, U.S. dollars going out into far distant international markets. So it's interesting. Kwanzaa. We've heard from some of the panelists, about aggressive pricing in the multifamily space, very aggressive cap rates, sub-4 in some instances. On top of that, we've heard a lot throughout the day about how some would-be home buyers are sticking with renting because of today's high mortgage rates. In your opinion, is this further exacerbating America's housing affordability issue? I know, Professor Glenn thinks so. Can you share some perspectives from local to national governmental bodies relative to affordable/attainable housing and economic development challenges and opportunities?
Thank you. I'll say yes, absolutely. Cities, states, counties, and nations are facing significant challenges around housing, just the shortage of housing, and then attainability of housing and the price points of housing. I'm based in Atlanta, and a lot of foreign direct investment came because of significant projects that are happening in the city. Dallas has experienced that. Other Sunbelt cities have experienced that, and people are buying without even seeing the property. Runs all the numbers up, and it makes it very difficult for working families, even middle-class families, to be able to have housing, even if the jobs are nearby. And then you have other states that are seeing significant economic development projects, and there's a need for wholesale housing solutions to match up with the demand that's being created. So we're definitely feeling these pressures. They're around the globe, and I think we've got to think out of the box and come up with innovative solutions that can truly begin to address how you hold the land costs down. Maybe it's public use of land in the developments that takes that one layer down. Creative financing, using different layers of bonds and other creative tools. Development authorities can help out. And then I think it's just, the market has to agree. If we all don't come together and the rates stay high, we all lose.
Yeah.
So it's a race to the bottom if we don't work as a team.
Yep. From my perspective, I think that we are definitely at a point where there are very visible cracks in the foundation. A lot of people I talk to are surprised that things aren't worse than they are currently. I do think we are in for some rough road ahead. But at the same time, I'm also one of those people that believes that from chaos emerges opportunity. A few of the panelists have talked about some of the opportunities that they're looking at now. And hence, to bring this full circle, complicated, but because chaos brings opportunity, worth it. Just like me, your moderator. Anyway, thanks so much for your attention, and thank you so much for the panelists.